Do you fear market volatility but still want to diversify your portfolio with equities? Investing in equity savings funds gives you exposure to equities without worrying too much about the market volatility. Hello and welcome. I am Prarthana from Clear, India's largest tax and financial services platform. At Clear, we have assisted 6 million plus tax filers so far. If you have not already, do subscribe to our channel to support us. Equity savings funds are hybrid mutual funds that invest your money in a mix of equity, debt, and arbitrage. According to SEBI rules, equity savings funds must invest at least 65% of their assets in equity and equity related instruments and 10% in debt securities. Equity savings funds look for arbitrage opportunities, which is the simultaneous purchase and sale of identical securities in two different market entities. Arbitrage uses the price difference of the same security in different markets during market volatility to make profits. Suppose a stock trades at Rs 105 in the spot market and at Rs 110 in 1 month futures market. A spot market is a marketplace where securities are bought and paid for at the point of sale. Futures markets are auction markets where participants lock in the future delivery of a security at a price set today. The fund manager purchases the stock at Rs 105 from the spot market and simultaneously sells it at Rs 110 at the futures market. He will lock the profit of Rs 5 irrespective of the security's price on the settlement day. Suppose the price of a stock is Rs 100 in the cash market and 102 in the futures market at the beginning of the month. The fund manager buys the stock in the cash market at Rs 100 and simultaneously sells it at Rs 102, locking a risk-free profit of Rs 2. Profits get locked in as on expiry of the futures contract. The cash price converges with the futures price irrespective of whether the stock prices move up or down. Equity savings funds do not have the safety levels of bank fixed deposits and short-term debt funds. However, they use arbitrage opportunities to offer you a higher post-tax returns in exchange for a small technical increase in risk. Equity savings funds have a sizable allocation towards debt in their portfolio. It cushions your investment against stock market fluctuations, particularly when stock markets crash. As equity savings funds have a minimum allocation of 65% towards equity and equity related instruments, they are taxed as equity funds. It makes them tax efficient as compared to debt funds, as long-term capital gains up to Rs 1 lakh per annum are tax-free. You may consider equity savings funds if you are a conservative investor who seeks some equity exposure. You could invest in equity savings fund if you have a time horizon of 2 to 3 years. First timers in the stock market who are averse to high risk could try equity savings funds, as its sizable debt holdings protect you during a market crash. Moreover, the equity portion enhances your returns when stock markets do well. Equity savings funds are suitable if you want to diversify a portfolio beyond bank FDs and recurring deposits. Moreover, it is tax efficient compared to these investments, as it is taxed similarly to equity funds, making it suitable if you fall in the higher tax brackets. Equity savings funds may be suitable during volatile stock markets. For instance, the fund manager reduces portfolio allocation towards equity and increases allocation towards arbitrage during volatile markets to tap opportunities to make risk-free profit. As equity savings funds have a high equity exposure, they are not as safe as debt funds but are relatively safer than pure equity funds. You must check the debt portion of the equity savings funds portfolio for exposure to AAA rated bonds. Otherwise, your investment is vulnerable to credit risk, as lower rated bonds may default on their principal and interest payments. Some equity savings funds may have higher expense ratio. It is the cost of managing the fund, and a higher expense ratio reduces your take-home returns over some time. I hope by now you have understood how equity savings funds work. Comment clear if you are clear, or drop your questions if any. Don't you want to know more about the L&T Equity Savings Fund? L&T Equity Savings Fund Direct Plan Growth is an equity savings fund offered by L&T Mutual Fund and was launched on 1st January 2013. This fund aims to generate regular income through arbitrage opportunities in the cash and derivatives segment of equity markets. It invests 66.01% of its assets in domestic equities, out of which 40.35% is in large cap stocks, 8.22% is in mid cap, and 13.14% in the small cap stocks. L&T Equity Savings Fund has an exposure of 27.49% towards debt securities. Moreover, this fund has assets under management of Rs 206 crore with a Morningstar rating of 3. L&T Equity Savings Fund has an exit load of 0.5%. It means for units above 10% of the investment, you will be charged 0.5% if you redeem within 30 days.
This table is showing sectors holding in L&T Equity Savings Fund's Direct Plan Growth. L&T Equity Savings Fund's Direct Plan Growth has moderate risks as shown in the riskometer. L&T Equity Savings Fund's Direct Plan Growth has outperformed its category with a CAGR of 9.21% against a category average of 7.31% over 3 years. Moreover, this fund has generated a CAGR of 7.47% over 5 years against a category average of 6.62%. As the debt portfolio of this fund is biased towards AAA rated bonds, the chances of default on principal and interest payment is low, protecting you from a credit risk. L&T Equity Savings Fund's Direct Plan Growth has an expense ratio of 0.69% against a category average of 0.79%. It is the percentage of the fund's asset used for administration, advertisement, management, and other expenses. A lower expense ratio increases your overall returns over time.
You may invest in L&T Equity Savings Fund Direct Plan Growth if you have an investment horizon of 2 to 3 years to attain financial goals. It has a lower expense ratio than the category average and has also outperformed the category average over 3 and 5 years. However, you must understand that L&T Equity Savings Fund Direct Plan Growth is more volatile than several peers, even though it may generate a higher return. Thank you so much for watching this video. If you have any queries related to investments and taxes, please do comment them below. We will address them as soon as possible. Stay tuned for more updates and also don't forget to subscribe to our channel for finance related content. Take care and goodbye.